Welcome back, looters. I am your host on Tick to Loot, the channel where we turn ticks into treasure. Today we are on Lesson 11.21 of Unit 11, Algorithmic Trading Fundamentals. In this lesson, we're going to cover three essential ideas. First, what spread costs actually mean when you write an algorithmic trading program. Second, why those spread costs matter for every trader, whether you're a human or a bot. And third, a quick look at how brokers quote those spreads on the most popular currency pairs. By the end of this video, you'll be able to read a broker's spread quote, calculate the hidden cost of a single trade, and understand how that tiny cost can add up to a big difference in your algorithm's performance. I'll walk you through a simple real-world example using the euro to US dollar pair, show the math step by step, and point out the most common mistake beginners make, ignoring the spread entirely. So grab a notebook, keep your curiosity switched on, and let's dive into the world of spread cost together. Let's start by unpacking what a spread actually is, especially when you're writing an algorithm that automatically places orders. In the Forex market, a broker shows you two prices for every currency pair. The ask price, which is the price you pay if you want to buy, and the bid price, which is the price you receive if you sell. The difference between those two numbers is called the spread. Think of it like a small service fee that a shop adds to every item. If you walk into a store and the listed price of a soda is $1, you might actually pay $1.02 because the cashier adds a 2-cent handling charge. In the same way, if the broker quotes euro to US dollar an ask of 1.1050 and a bid of 1.1048, the spread is 0.0002, which we call 2 pips. A pip is the standard tiny unit of price movement in Forex. For an algorithm, that spread is a built-in cost that occurs the moment you open a position, regardless of whether the market moves up or down. If you program a bot to buy euro to US dollar at the ask and then immediately sell at the bid, you will lose exactly those 2 pips, not because the market moved, but because the spread ate that amount. To calculate it, you simply subtract the bid price from the ask price. Spread equals ask bid. In our example, 1.1050 minus 1.1048 equals 0.0002, or 2 pips, which at a standard lot size of 100,000 euros translates to about $20 in cost. Knowing this number is the first step to building a realistic algo that accounts for every dollar that leaves your account. Now that we know what a spread is, let's talk about why it matters for every trader, especially those building algorithms that execute dozens or hundreds of trades a day. Imagine you're a baker selling cupcakes. If each cupcake costs you 10 cents in ingredients, that tiny expense seems harmless until you bake 1,000 cupcakes. Suddenly you have spent $100 just on flour. The same principle applies to spread costs. Every time your algo opens a trade, the spread is taken out of your pocket the instant the order is filled. For a single trade, the cost might look small. 2 pips on a euro to US dollar position might be $20 for a standard lot. But if your strategy makes 20 trades a day, that adds up to $400 in hidden fees before the market even moves. Those fees erode the profit margin and can even turn a winning strategy into a losing one when you run a backtest. In our visual example, a trade that looks like it would earn $150 on paper drops to $130 after subtracting the $20 spread cost, a 13% reduction in profit. Over weeks or months, that reduction compounds, making risk management harder because you are effectively operating with less capital than you think. Ignoring the spread also leads to unrealistic expectations. You might backtest a strategy on historical price data that shows a 10% return, but once you add realistic spread assumptions, the net return could fall to 7 or 8%. That is why seasoned traders always build the spread into their profit calculations, adjust position sizes, or even choose brokers with tighter spreads to keep costs low. Understanding this hidden expense is the foundation for creating a robust, profitable algorithm. All right, looters, let's dive into how brokers actually quote spreads on currency pairs. Imagine you walk into a grocery store to buy a bottle of water. The shelf price says $1. But the cashier rings you up for $1.20. That extra 20 cents is the store's markup, the difference between what they're willing to sell to you and what they're willing to buy from you. In Forex, the same idea exists, but instead of water, we have currency pairs like euro to US dollar. A broker shows you two numbers for every pair, the bid price and the ask price. The bid is the price the broker is ready to buy the base currency from you. Think of it as the price the store will give you for your old bottle. The ask is the price the broker is ready to sell the base currency to you, like the price you have to pay for a new bottle. The spread is simply the difference between those two numbers, measured in pips, which are the smallest price moves in Forex. For example, if euro to US dollar is quoted as 1.1050/1.1053, the bid is 1.1050 and the ask is 1.1053, so the spread is 3 pips. Brokers may offer a fixed spread that never changes or a variable spread that widens when the market is volatile, similar to a store raising its markup during a rush hour. Understanding this quote structure is crucial because every trade you make starts with paying that spread, just like paying the store's markup before you even drink the water. In the next scene, we'll walk through a real-world trade and see exactly how those 3 pips affect your profit. Now let's bring the spread to life with a simple, real-world euro to US dollar trade. Suppose you have decided to go long, meaning you want to buy euros with dollars because you think the euro will rise. You look at your broker's price quote and see a bid of 1.1050 and an ask of 1.1053. Remember, the ask is the price you must pay to buy euros, so your entry price is 1.1053. The spread here is 3 pips. That's the difference between 1.1053 and 1.1050, or 0.0003 in decimal terms. Think of each pip as a tiny step on a ruler. 3 pips is like moving 3 tiny ticks forward. If you open a standard mini lot of 0.10 lots, each pip is worth $1, so the spread costs you $3 right at the moment you enter the trade. Let's say the market moves in your favor and the price climbs to 1.1060. Without spread, your profit would be 70 pips, but because you paid 3 pips up front, your net profit is actually 67 pips, or $67 for that mini lot. In other words, the spread ate away $3 from your potential gain. This example shows that even a small spread can matter, especially on short-term trades where every pip counts. If you were trading a larger position, the spread cost would scale up proportionally, just like buying a bigger bottle of water would increase the markup you pay. Keep this in mind whenever you design an algorithm. You must factor in that initial cost before you can start counting profits. Finally, let's see how you actually embed spread costs into an algorithmic trading script, step by step. Imagine you're writing a simple Python-like pseudocode for a strategy that buys euro to US dollar whenever a moving average crossover occurs. The first thing your code does is pull the current ask price, because that's the price you'll pay to open a long position. So you write, price equals get current ask, euro to US dollar. Next, you need the current spread, which you can retrieve with a function like getSpread, euro to US dollar. In our earlier example, the spread was 3 pips, or 0.0003. Now you set your entry price. Entry price equals price. The crucial part is calculating the monetary cost of that spread. You multiply the spread in pips by the lot size and the value of 1 pip. For a mini lot of 0.10 lots, 1 pip equals $1, so the cost line becomes cost equals spread asterisk lot size asterisk pip value. Plugging in the numbers, cost is equal to 0.000, 3 times 0.10 times 10,000 equals $3. This $3 is deducted from any future profit the trade generates. When you later close the trade, you compute the gross profit as the difference between the exit price and the entry price multiplied by lot size and pip value. Then you subtract the spread cost to get net profit. Net profit equals gross profit cost. To visualize the impact, picture a profit chart where the green line shows gross profit after each trade, while the red line, slightly lower, shows net profit after accounting for spread. Over many trades, those small deductions add up, especially for high-frequency strategies that open and close positions many times a day. By coding the spread cost directly into your algorithm, you ensure every backtest result reflects real-world trading conditions, and you avoid the common beginner mistake of assuming a zero-cost entry. Remember, the spread is a fixed expense per trade, just like a transaction fee, and must be part of your risk management calculations. With this approach, your algo will be more realistic, and you'll have a clearer picture of true profitability. All right, looters, let's see exactly how a spread can eat into the profit of a trade, even when the market moves in your favor. Imagine you have a very simple algorithm that buys the euro against the US dollar, the euro to US dollar pair, whenever it sees a tiny upward tick. In our example, the algorithm decides to go long at an ask price of 1.1000. The ask price is the price you pay when you buy, just like the sticker price on a product. At the same moment, the bid price, what you would receive if you sold, sits a couple of pips lower at 1.0998. That 2-pip difference is called the spread, and it is a built-in cost charged by the broker. Your algorithm holds the position for a short time and exits when a market reaches a bid price of 1.1015. If you ignore the spread, you might think you made a clean 15-pip gain because 1.1015 minus 1.1000 equals 0.0015 or 15 pips. But the reality is you paid 2 pips up front just to get into the trade. So your actual profit is 15 pips minus the 2-pip spread, leaving you with a net gain of 13 pips. In dollar terms, if you were trading a standard mini lot worth $10 per pip, that spread cost would have cost you $20, reducing a $150 gain to $130. The key takeaway is simple. Every trade you open starts with a small hidden tax, the spread. If you don't subtract that tax before you calculate your profit, you will always overestimate how well your algorithm is performing. From now on, always write your profit formulas as gross move minus spread cost equals net profit, and you'll have a much clearer picture of what your strategy truly earns. Now let's talk about the most common mistake beginners make, ignoring the spread altogether. Picture yourself as a new trader who just built a tiny algorithm that tries to capture 5 pips moves on the euro to US dollar pair. You backtest the code on historical price data, and every time the price nudges up by 5 pips, your script records a win. The backtest report flashes green numbers and tells you, average profit per trade, 5 pips. Sounds great, right? But there's a hidden detail that most novices overlook. The price you see in the chart is the mid price, the average of the bid and ask, and it does not reflect the actual cost of entering and exiting a trade. In reality, when you place a buy order, you pay the ask price, which is typically a couple of pips higher than mid price. When you close the trade, you receive the bid price, which is a couple of pips lower. If the broker spread on euro to US dollar is 2 pips, you immediately lose those 2 pips the moment you open the position. So instead of a clean 5-pip gain, you only net 3 pips. If you keep running this strategy without accounting for the spread, your cumulative profit will be far lower than the backtest suggested, and you may even end up in the red after commissions and slippage. The practical rule here is always build the spread into your profit calculations from day one. Add a line in your code that subtracts the current spread value from any potential gain before you record the trade as a win. This simple habit will save you from chasing phantom profits and keep your algorithm realistic. Finally, let's walk through a concrete case study that shows exactly how ignoring spread can turn a promising trade into a missed opportunity. Imagine you wrote a simple algorithm that goes long on euro to US dollar whenever the 10-period moving average crosses above the 30-period moving average. You backtested this logic on the past month of data, and because the chart you used displayed only mid-prices, the software reported an average profit of 10 pips per trade. On day 12 of the test, the algorithm entered a long position at a price of 1.1050 and exited at 1.1060, a tidy 10-pip move. If you look only at the mid-price, that looks like a solid win. But now we add the broker's actual spread, which for euro to US dollar at that time was 2 pips. When the trade opened, the ask price you paid was 1.1052, not 1.1050. And when you closed, the bid you received was 1.1058, not 1.1060. Those 2 pips of spread cost eat away from the 10-pip gain, leaving you with only 8 pips of net profit. In the backtest chart, you'll see two equity lines. The green line that assumes no spread climbs steadily, while the red line that includes the 2 pips spread flattens out and even dips on the day of the trade. Over a series of 30 trades, that 2-pip loss per trade can shave off a substantial portion of your total earnings, sometimes turning an overall profit into a break-even result. The lesson here is crystal clear. Always run your backtests with realistic spread values. Most trading platforms let you input a fixed spread or pull the live spread from the broker. By doing so, you'll see a more honest picture of how your algorithm performs in the real world, and you can adjust entry thresholds or position sizes accordingly. In short, a tiny 2-pip cost may seem insignificant, but multiplied across many trades, it becomes a major factor in your bottom line. All right, looters, let's walk through the exact steps you need to add spread costs into your very first algorithmic trading script. First, remember that a spread is simply the difference between the price a broker will sell you, the ask, and the price they will buy from you, the bid. Think of it like the small fee a grocery store adds when you buy an apple versus when you sell one back. There's a tiny gap. In code, the easiest way to capture that gap is to pull both the bid and ask prices from your broker's data feed. You'll typically see them labeled as bid and ask in the API. Create 2 variables, for example, bid_price and ask_price, and assign the live values each time your algo evaluates a new tick. Next, calculate the spread by subtracting bid_price from ask_price. Spread equals ask_price, bid_price. This gives you a numeric value in pips or points that you can store for later use. Now, when you decide to open a long, buy, position, you will actually pay the ask price, so your entry_price should be set to ask_price. Conversely, for a short, sell, position, you will receive the bid price, so exit_price becomes bid_price. By explicitly using these prices instead of a generic close price, your profit calculation automatically includes the spread. For example, if euro to US dollar is quoted with a bid of 1.1200 and an ask of 1.1202, the spread is 0.0002 or 2 pips. If you buy at the ask 1.1202 and later sell at a new bid of 1.1205, your raw price movement looks like a gain of 3 pips, but after subtracting the original 2-pip spread, your net profit is only 1 pip. Finally, you can store the spread value in a separate variable called current_spread and log it each trade for later analysis. This step-by-step method ensures your algorithm never pretends it earned more than it really did, keeping your performance numbers honest from day one. Now that you know how to code the spread, let's see why testing that code matters. Backtesting is simply running your algorithm on historical price data to see how it would have performed in the past. Much like a flight simulator lets a pilot practice without leaving the ground. The key is to make sure the simulator mimics the real world as closely as possible, and that includes the spread. Imagine you built a simple euro to US dollar scalping bot that buys whenever the price moves up 2 pips and sells after 4 pips. If you backtest without any spread, the bot might show a tidy profit of, say, 5 pips per trade. But in reality, each trade starts by paying the ask price and ends by receiving the bid price, so you lose the spread on every round trip. To test this, run the same set of historical ticks twice, first with a spread of 0, then with a realistic broker spread, perhaps 2 pips for euro to US dollar. In the equity curve, you'll notice the green line, with spread, lags behind the red line without spread. In our example, the bot's average profit per trade drops from 5 pips to 3 pips after accounting for the 2-pip spread. That 3-pip net profit may still be viable, but the margin is thinner and the break-even win rate rises. By comparing these two curves, you can decide whether the strategy's edge is strong enough to survive the spread cost. It also helps you spot strategies that look great on paper but crumble once you add the inevitable friction of real-world trading. Remember to log the spread used for each backtest run, so you can track how changes in market conditions, like a widening spread during low liquidity times, might affect your results. This disciplined testing step protects you from over-optimistic expectations and keeps your algo grounded in reality. Finally, let's connect spread costs to the bigger picture of risk management, which is the safety net that keeps any trader from wiping out their account. Think of risk management as the budget you set for a road trip. You decide how much fuel you can afford to spend, how far you can drive, and you factor in traffic delays. In trading, the fuel is the amount of capital you risk on each trade, usually expressed as a percentage of your account or a fixed number of pips. The spread directly eats into that budget because it adds an unavoidable cost the moment you open a position. To incorporate spread, start by calculating the expected spread for the currency pair you plan to trade. For euro to US dollar, a typical retail broker might quote a 2-pip spread during normal hours. Next, adjust your entry and exit price expectations. If you intend to buy at 1.1200, you actually pay the ask, perhaps 1.1202, so your trade starts 2 pips in the red. When you set your stop loss, you must add those 2 pips to the distance you're willing to let the price move against you. For example, if you normally risk 10 pips, you now need to set the stop loss 12 pips away from your entry to preserve the original risk tolerance. This also influences position sizing. If you risk $100 per trade and each pip is worth $1, a 10-pip risk equals $100. But with a 2-pip spread, the effective risk becomes 12 pips or $120, which exceeds your target. To stay within $100, you would reduce the lot size so that each pip is worth roughly 83 cents, bringing the total risk back to $100. By systematically adjusting entry, stop loss, and position size for the spread, you ensure that the hidden cost never pushes your risk beyond the limits you set. This disciplined approach links the tiny tick of a spread to the overall health of your trading account, keeping you in control even when market conditions widen the spread during news events or low liquidity periods. Welcome back, looters. We've just wrapped up a deep dive into spread costs and algorithmic trading. It's time to lock in what we've learned and look ahead. First, we clarified what a spread actually is, the tiny gap between the price a broker offers you to buy a currency and the price they'll let you sell it. Think of it like the service fee a shop adds when you buy a product. Even if the product itself costs the same, that extra charge affects your bottom line. Next, we explored why that seemingly small number matters for every trader, especially when you're running an algorithm that can execute dozens or hundreds of trades in a single day. Those tiny fees add up fast, turning a potential profit into a break-even or even a loss if you ignore them. We then looked at how brokers quote spreads on major pairs like euro to US dollar, showing you a live quote screen with the bid and ask prices highlighted in green and red, respectively. To make it concrete, we walked through a simple real-world example. Buying euro to US dollar at 1.1000 and selling at 1.1002 with a 2-pip spread, which instantly eats away half of that 2-pip gain. After that, we've demonstrated how to calculate spread cost directly inside your Algo code, subtracting the spread from each trade's profit calculation. We discussed the impact on overall profitability, highlighting a case study where a trader missed out on a $150 profit simply because the spread wasn't accounted for in the backtest. The common beginner mistake? Ignoring the spread entirely and assuming the market will always move in your favor. We then gave you a step-by-step guide to add spread handling to your algorithm, test those adjustments in a backtest, and tie the results into your broader risk management plan. Remember, a well-tuned Algo respects every cost, no matter how small, because those details protect your capital over the long run. That is everything for Lesson 11.21, Spread Costs in Algo Trading. If this helped you, smash that like button and subscribe to Tick to Loot so you never miss a lesson. Drop a comment below. What was the most useful thing you learned today? See you in the next lesson, looters. Keep turning those ticks into treasure.